You bought the house, you pay the mortgage, you mow the lawn, but you're also paying one of the biggest hidden costs of home ownership, taxes. What if I told you that the wealthy aren't paying more in taxes? They're just playing by a smarter legal rulebook. In today's video, I'm walking you through the most powerful, ethical, IRS-approved tax saving strategies every homeowner should know. These aren't loopholes. These are legit tax laws that anyone from first-time homeowners to seasoned property pros can use to keep more money in your pocket. Let's get started. To reduce your taxes, you don't need to cheat. You need to understand the system. The IRS gives homeowners legal ways to reduce taxable income through deductions and credits. Deductions reduce taxable income, and credits reduce the actual taxes you owe. Here's a stat. According to the IRS, homeowners who itemize save an average of $3,500 to $5,000 annually in taxes compared to renters. Most Americans think tax season starts in January and ends in April, but smart homeowners know that the best tax savings begin the moment you close on your house. The tax code is essentially an incentive structure, and owning a home gives you a front row seat to some of the IRS's most generous benefits. In fact, the government wants you to buy real estate because it stabilizes neighborhoods, grows wealth, and encourages long-term investment in communities. That's why so many deductions, credits, and exclusions are built directly into the tax code to reward homeownership. There's a catch. You must track your expenses and choose to itemize rather than take the standard deduction, which is $14,600 for individuals and $29,200 for married couples in 2025. If your deductions exceed that threshold, itemizing becomes your gateway to serious tax savings. Here's the viral insight that most people don't realize. Homeowners who itemize can access over 10 types of deductions and credits, but the average taxpayer only claims 2 or 3. That's money left on the table. By simply understanding what counts and what doesn't, you can potentially shave thousands off your tax bill year after year. If you own a home with a mortgage, you're likely paying thousands in interest annually. The good news, the IRS lets you deduct that. Up to $750,000 in mortgage debt for interest deduction. Mortgage must be used to buy, build, or improve your primary or secondary home. These are just the 2 limitations to this. Here's a real-life example. You have a mortgage balance of $400,000. Interest paid this year has been $12,000, and you're in the 24% tax bracket. You save $2,800 in taxes just by itemizing. Use IRS Form 1098 provided by your lender to itemize these tax deductions. Let's face it, property taxes are painful, but smart homeowners write them off. Deductible through the SALT deduction cap. $10,000 max for combined state and local taxes, specifically property plus income sales tax. According to ATTM, average property tax in the US is close to $2,800 per household. Here's a pro tip though. Keep your county and city tax records organized for audit-proof deductions. If you're self-employed and working from home, you can deduct a portion of your home's expenses. Here are the requirements though. Space must be used exclusively and regularly for business. Here are 2 methods. Simplified, $5 per square foot up to 300 square foot, which equals a maximum deduction of $1,500 for your office space. Or you can use the actual expense. Deduct a portion of utilities, rent, mortgage, insurance costs, and you can deduct those from your overall tax bill at the end of the year. Here's a real-life example. Your home office is 10% of your home. Annual expenses, specifically utilities, interest, and insurance, is $20,000 for that 10% of your home. That's a $2,000 deduction. With over 44 million self-employed Americans in 2025 and counting, the home office deduction is one of the most underutilized tax benefits in the country. But here's the part most people miss. Even part-time freelancers, consultants, and side hustlers can qualify. You don't need to own a business or even have an LLC. You just need to show consistent, trackable income and designate a portion of your home for exclusive business use. Think of your home office as a mini headquarters. If you host virtual meetings, edit videos, manage clients, or handle inventory from a spare room, you're operating a legitimate business, and the IRS allows you to deduct a share of your internet, electric, water, HVAC, renters, home insurance, and even repairs related to that space. That adds up fast, and if you use the actual expense method, your tax savings can scale with your business. Imagine deducting 15% of your home's annual operating costs just for doing what you're already doing. If your utility bills are close to $5,000 per year and your insurance is another $1,500, that's a $1,000 deduction before even touching your mortgage interest or appreciation. Saving the planet and your wallet. Yes, please. The Inflation Reduction Act now offers 30% credit for solar panels, geothermal systems, and battery storage. That's up to $1,200 per year in credits for insulation, HVAC, windows, and doors. Here's an example. Say you install an $18,000 set of solar panels. That's a $5,400 tax credit off your federal tax bill. Here's a pro tip though. Look for Energy Star certified appliances for bonus credits. Let's talk numbers though. The average homeowner who installs energy sufficient upgrades like solar panels or geothermal heat pumps in 2025 saves around $700 to $1,500 annually in utility costs. And that's before the federal tax credit kicks in. When you layer in state level incentives, utility companies, rebates, and local grants, your out-of-pocket costs can drop by 40 to 60%, making energy retrofits one of the best ROI moves a homeowner can make. Here's the secret. Most homeowners don't realize that these upgrades are stackable. You can claim 30% of the cost of solar plus up to $1,200 in annual credits for installation, windows, air, ceiling, and more. That means you could claim $6,000 plus in tax credits in 1 year alone. If you're proactive, that's a dollar for dollar reduction on what you owe the IRS. Selling your home doesn't have to mean paying a big tax bill. Here's the exclusion rule though. You can sell your home for up to $250K single and $500K married, a profit tax-free. You've lived in a home for 2 out of the last 5 years. It's your primary residence. But that. Here's a real life example. You bought a home at $300,000 and sold it for $800,000. You owe a $500,000 gain, but married couples pay zero in federal capital gains taxes. If you rent part of your home, you're eligible to depreciate the rented portion, and that's a massive long-term strategy. Residential depreciation is typically 27.5 years. Only the structure, not land, can be depreciated though. Here's a real-life example. Say you own a duplex. The structure value is $300,000. Depreciation runs at about $12,000 a year. You deduct this amount from rental income even if your cash flow is positive. Use Form 4562 plus Schedule E to deduct this. This is where real estate wealth begins to separate itself from every other asset class. When you rent out part of your property, whether it's a basement, apartment, a converted garage, or a multi-unit duplex, you can get access to depreciation, the most powerful non-cash tax deduction in the tax code. Why is it so powerful? Because depreciation lets you deduct a portion of your property's value every year without actually spending any money. It's literally a paper loss that shelters your real rental income. That means your cash flow might be positive, but the IRS sees a tax loss, so you often pay zero income tax on thousands of dollars in passive income. Home equity lines of credit or HELOCs are just for emergencies, and they can be strategic. Here's an example of a HELOC. Say you get a HELOC for $60,000. You use that money for a bathroom and to finish the basement. You pay $3,000 a year in interest. This interest is deductible if used for home improvements. Focus on capital improvements that increase value or extend the home life of the home. If you've got land or property you don't need, donating it could reduce your taxes while doing good. Donate appreciated property or land to a qualified nonprofit. You may deduct fair market value of the property, avoid capital gains taxes, and reduce your taxable income. But here's a pro tip. Must get an appraisal and file Form 8283 for large donations. The best tax strategy is only as good as the paper trail behind it. Always keep forms such as the 1098 mortgage interest form, property tax bills, utility and insurance statements, HELOC use records, receipts for renovations and green upgrades, home office layout photos, and business records. Use software like Keeper, QuickBooks, or even a simple spreadsheet. Always work with a tax professional or CPA to confirm strategy eligibility. If you want to stay off the IRS's radar, documentation is your first defense. Tax courts side with taxpayers who can prove their claims. That means for every deduction or credit you take, you should have a clear, dated, and categorized evidence. Keep digital backups of everything: receipts, invoices, Form 1098s, W-9s from tenants or vendors, energy certification letters, home office sketches, and repair logs. The IRS audits less than 0.5% of all returns, but that rate goes up significantly when you claim unusual or large deductions, especially home office, solar, and rental-related expenses. Use apps like Evernote, Google Drive, or Expensify to stay organized. You don't need to be perfect, just consistent and transparent. The real key is separation and simplicity. Keep personal and business expenses separate. Use a dedicated credit card for home-related purchases, a spreadsheet for energy upgrades, and a cloud folder labeled taxes with the year with subfolders by category. Not only will this save you time and stress, it could also save you thousands in penalties if the IRS ever knocks. You don't have to be rich to play like the rich. You just need to be informed, intentional, and strategic. Every dollar you save in taxes is a dollar you can reinvest into your home, your family, or your future. So be smart, stay organized, and use these legal, ethical, and time-tested tax-saving strategies to your advantage. And if you found this video helpful, hit that like button, subscribe for more real estate and financial education, and drop a comment with your favorite strategy. I'll see you in the next one.